Welcome to Lighthouse Outlook, the podcast where we talk less about the markets and more about what matters to the people navigating them. From family offices to founders, we go beyond the numbers to unpack risk, legacy, and the human side of capital. Hosted by the team at McNichol & Associates Asset Management.
Awesome. Morning, a weekly research call, week of April 9th. Obviously a lot going on in the market today and then this week for that matter. So lots to discuss. First off, Canadian disclaimer for our clients and prospects within Canada. Contact us if you have any questions. None of what we're talking about is meant to be securities advice or tax advice. Same thing for the United States. Disclaimer from our regulatory advisory service from the SEC. Quickly just jumping through. You might want to buzz Joe. Looking at the S&P 500, a $3 increase this week driven by obviously yesterday's large move. There's some short-term optimism obviously with the ceasefire. But I think it could be overdone, obviously. There's still a lot of stipulations around the ceasefire, quote unquote. Energy prices obviously really volatile right now, but still trading in the 90s, the mid 90s. So the market does still see a lot of risk there. Prices are still much more elevated than the Trump administration obviously would hope. And probably no time soon we'll see a reversal into the previous long-term trend where oil got into the mid 50s at the low. On a weekly momentum streak, longest negative weekly streak since 2016, so some really sustained weakness there. Vertical price objective reversed to bullish this week. Positive move there. Overbought, oversold, still slightly oversold, and oversold 8 of the last 9 weeks. From a technical perspective, we're getting some mixed signals for the S&P right here with this resurgence. We'll have to see how it shakes out next week, but really monitoring these U.S. markets closely. Looking here, the NASDAQ, a $5 increase. New buy signal this week. Obviously, was driven predominantly by yesterday's move. Strong support was created 2 weeks ago that coincides with September and August support from last year. Some long-term support there. It's above the 200 moving day average for the first time in 3 weeks. Longest negative weekly momentum streak since late 24, early 25. Basically, most of early 25. There's a long-term negative weekly streak, I think, that reached 16 weeks. Overbought, oversold, overbought for the first time in 10 weeks. So a return to the tech trade, it seems, at least for now. I looked at a heat map of the NASDAQ 100 last night, and really strong week. You obviously, yesterday kind of led the charge, but over the past week, the market obviously some strong returns, really being driven by a lot of the laggards this week, AI and tech. So we'll have to see if we're kind of rotating back into that trade or it was just a little false signal. Looking here at the Dow, it's a $6 increase this week, a second straight buy signal created. That's the first time since December and the first week of this year, January. It broke its trend line, which it's been under since February, so that's a positive move. Obviously, last week, some reversals. This week, a continued ascension. So the Dow really does look the strongest in terms of its technical outlook amongst the U.S. indices. Obviously, fundamentally, it is the most attractive as well, too. Overbought, oversold, however, 7th straight week oversold, but a large increase this week. So watching that really closely. TSX, $4 increase this week. It's had a nice little rebound over the last 2 weeks. Some broad TSX strength, despite obviously the energy weakness. Price target moved up, which is positive. Overbought, oversold, highest since February. It was a strong week for a number of TSX components, including financials, miners, and even some of the cyclical names. But you can see also here, The TSX is only 3 boxes away from its all-time high and sitting at some resistance from back in March. So really on a relative basis, outperforming its US counterparts. Looking here at the VIX quickly, got a large plunge yesterday, obviously, but still, other than that, just following that same trend line. It did break the trend line yesterday by 1 box, but it needs to be under that for, I think, 3 trading sessions in a row to officially change the trend. So we'll be watching that really closely from here to see if the overall trend that we've seen start at the start of this year reverses. I'm looking here, bullish percentage charts, not a lot of movement. I did mention the S&P 500 gaining some strength. Reversal here for the bullish percentage chart, so kind of coincides with a bit of a turnover in the S&P. The Dow here for the percent positive trend. This is a bit of a slower moving chart. I've mentioned it before, so bit of a laggard, but right now 50% of the Dow companies trading in a positive, 50% in the negative trend. Kind of coincides with what the indice looks like right now on the technical charts. Looking here, the TSX, we had a reversal on the bullish percentage chart, which is positive for Canadian equities. Percent positive trend. No reversal yet, but really watching this chart closely after pulling back just over 2 months pretty quickly, despite the TSX still performing quite well. Looking here at the asset class rankings, not a lot of movement. I'll be talking about a couple of these major asset classes later in this presentation, but just wanted to highlight, obviously, energy. I didn't notice this change. I checked this on Tuesday and then yesterday, so it might be a little lag in terms of reporting or in terms of the Dorsey Wright database. So watching that for next week, just with the plunge in the price of oil yesterday, I assume that would have moved down. Now, speaking of oil, this is just the U.S. retail diesel price adjusted for inflation since 1994. You can see the surge that we've had, obviously, right now. One of the largest rapid increases that we've had dating back to the 90s, obviously, but nowhere near the 2008 levels, and then even the 2022 when the invasion of Ukraine by Russia, there was obviously that long-term surge that we had over multiple months. Right now, we've only been dealing with this for, I guess you could say, a month. And then here's crude oil over since the 1980s, and you can see these orange lines represent a 10% plus daily move. Yesterday, crude recorded has officially recorded 5 trading days where the price of oil moved on an absolute basis greater than 10%. So obviously, volatility exists. Similar periods include Russia, Ukraine, COVID-19 shock. But you look back to 1983, these periods of sharp volatility have generally been followed by some mean reversion toward historical norms over the next year. Dorsey Wright basically outlines there is heightened geopolitical risk right now, so they wouldn't say it now, but they would assume perhaps at the end of this very volatile period, there could be some price stability for the price of energy in the following year. So really watching that. Now, looking here, Dorsey Wright always writes an interesting piece on the Dow transports and the Dow transports theory, which obviously suggests that the forward-looking nature of broad market converges with the actual transportation of goods and services around the nation. And you can see some strong movements in the past 2 to 3 weeks for the Dow transports ETF here. 3 straight buy signals, heavily overbought over the last few weeks, and actually at a point where you potentially might want to wait for a bit of a pullback and pull back to some support and enter for a re-entry position. really implying that the market and the economy resilient, which kind of coincides with what a lot of earnings are forecasting and showing. Jamie Dimon's newsletter or with JP Morgan's earnings, and that was kind of the major theme I took out of it: the resilience of the U.S. economy, and then obviously the private credit issues. But major topic there. Looking here, this is just an interesting chart that I saw in a newsletter that tracks emerging markets and the U.S. equities, and tracks their PE ratios. Obviously, U.S. equities, price to earnings, cyclically adjusted price to earnings ratio, much more elevated than the emerging markets. You can see there the emerging markets is trading at about a 59% discount to the U.S. and trading well below its all-time highs, whereas the U.S. is trading fractionally off its all-time highs and is at a very elevated level. So I think there's a strong opportunity set there. We've been talking about it for a long time. Kind of coincides with a chart like this, where you're looking at market cap to GDP, which countries are a little more undervalued. The one that we want to talk about, that I'm going to talk about, is Latin America, and even India for that matter. I have a quick chart on them, where we're looking at exposure, obviously, in various emerging markets, but also avoiding certain emerging markets. This is the PE ratio going back to 2023, so over the last few years. Not a lot of movement, but you can see here that the green line is the iShares INDA India ETF, trading at about 19.8 times. It's pulled back pretty heavily since about a year and a half ago, where the Indian market, like I said last week, is one of the weaker indices in terms of performance over the last year and a half. Now really attractive, I think, from an earnings perspective, where you still have that embedded growth, but you're buying at a much cheaper multiple. And then looking at the bottom, we own it, Mexico, EWW, trading at 13 times forward earnings. So really attractive there. We think that Mexico continue to benefit from nearshoring. Companies obviously much more willing to move with the policies that the United States has. So I think that the tailwinds for countries in the Latin American region, specifically Mexico, as well as India, are really bullish. And if you don't have any exposure, perhaps it's time to add some emerging market exposure. Looking here, this is a chart from Bloomberg Opinion in an article I read this week, just tracking the price of cattle in Chicago, which obviously is not just an Iran issue, or it's a long-term chart where you can just see the price of cattle substantially moving up. Dave always talks about the level of inflation being undersold or underreported. Excuse me, that's the right word. And I think a chart like this, from basically 2020 to now, the price of cattle in Chicago is increased by 2.5x in 5 years, or 5.5 to 6 years. The level of inflation across the United States, obviously, nowhere near that. So, continue to believe that inflation is one of our biggest enemies in financial markets, and just as consumers as a whole. Interesting chart. I saw this, wanted to highlight it from an article. Almost half of the U.S. data centers planned for this year are expected to be delayed or canceled. A big reason for that is a shortage of electrical equipment, such as transformers, switchgears, and batteries. Why is that happening? The U.S. is going to rely heavily on foreign imports to build these data centers. The one benefit I will say about the slowdown in these rollout of these data centers, energy prices may not surge as fast as we're assuming, and some of these companies may not be investing as heavily into the ambitious projects that they have in terms of data centers right off the get-go. So we kind of forecasted that some of this lofty 650, $700 billion in capex spending by the majors was going to be obviously deployed very slowly, but kind of coincides with that thought. And then last one, most of us, I think, on this call are in Toronto, and just looking at the Toronto MLS seasonally adjusted real estate index, well off its highs, but it moved lower in March once again. We've been out of the Toronto real estate market, obviously, for the most part, but pretty large drawdown there where it's closing in on about 25% since its peak. So just looking, obviously, more for information purposes and our viewers on the other end. And that's it for me.
Thank you, Ken. I got my IT going here. Only took about 10 minutes. Let's get business. Where is this damn thing? Okay. So I had a pretty good detailed update with IP Capital. Talk about that in a moment. The disclaimer, of course. And so Jason and Josh, we've known for over a decade. And, just checking my notes, I think the first LP that we did with them is back in 18. And, fast forward today, they essentially turned from, a couple of smart young guys in Boca Raton to, really helping us think a little bit differently about commercial real estate, specifically in connection with product types like office and industrial. So the first thing they mention in their year-end update. So this is obviously a slide of U.S. unemployment since the 80s, and superimposed over the line is a bunch of global events that investors would have worried about, and then when one of these events passed, then there was another thing to worry about, and a good example is this week we thought Trump was going to annihilate Persia, and now it's the question now that we're worried about is, well, how do these 50% tariffs on countries supplying munitions to Iran factor into this? So there's always something to worry about in financial markets, but with real estate, the by far the main variable should be employment, right? So if you're going into strong economy on the employment side, you do increase your chances of getting a good return. The next thing, and this is something that I think Jason and Josh do extremely well, is they don't obsess about cap rate spreads and financing and stuff like that. Well, they kind of do, but you don't really hear them. Like you go to a real estate conference and all anybody ever talks about is leasing velocity and cap rate spreads. What about a simple equation like more people equals more space needed equals more investment equals better returns, and it's really as simple as that. So what they've got here is the U.S. household buying power growth by market going back to 2015, and the one thing I'll point out is that we are in all of the markets where the bars are above the overall average for the United States. And that's, again, if you don't know anything about real estate investing, just being in some of these stronger markets from the perspective of household buying power is just going to increase your chances of a successful outcome. So that's very, very important. Turning to industrial, so I think a lot of people know that with the exception of Florida and a small legacy LP with KingSett, we aren't really big office investors. So we'll get to office in a moment. This is industrial, and this is sort of where the majority of the money's been going in our fund. That's not destined for sort of our main course, which is residential assets. You can see here the trailing 5-year actual demand number for square feet is about 1.3 billion, and the 5-year look ahead forecast for demand in terms of industrial, so storage, is much greater, and it's really underpinned again from a risk perspective by the fact that there's only about 1/4 of the needed amount of square footage currently under construction. So, again, if you're going to pick one, and there's another slide from the debt capital markets that speaks to this, but again, if you're going to pick one real estate product type, 10 years ago that was multifamily by a mile. It's now becoming pretty obvious that industrial is sort of the go-to asset class to have, and we've been going there. Focusing a little bit more, not that being myopic is a good thing, but really sort of drilling down and focusing just on Florida. Take a look at some of these sporting events that are estimated to inject hundreds of millions of dollars into the Florida and South Florida economy. Look at the Formula One race, the Miami Grand Prix, and just FIFA. So these are two events. The World Cup is, a tournament, but these are just two events, I think, in the grander scheme of things, that are projected to see spending in Miami grow by almost $2 billion. And even if these numbers are only sort of correct, they're still pretty big numbers. And when I look at a slide like this, right, I don't think about cap rates. I don't think about leasing velocity. I don't think about any of that. What I think about is Miami Mayor, right, Francis Suarez. He's got to be sitting in his office right now, and he sees a chart like this or a table like this, and he's just got to be grinning from ear to ear. Imagine being the mayor of a city that has this level of events coming your way. It's got to be something that makes you feel good. So just sort of talking about office, I think, again, the IPCAP team makes a pretty good point here in terms of essentially office product that's been removed from the system. Now, this is where kind of I would very respectfully differ with one point, but they consider office product that's been demolished or repurposed or whatever to be part of the, absorption number. I personally don't. I kind of think about real estate as, being a market that can either digest new deliveries or not. Taking stuff out of the equation is sort of, like a double negative. But for what it's worth, you can see here a lot of office products been removed. The groundbreakings on new offices in the United States have declined over the last couple of years, and the downsizing trend for a lot of the major tenants, which they define as 25,000 square feet or more, is trending back up. But just look at the numbers down in late 21 and 22 into COVID and through the post-pandemic period. Like, I think that lower point of that line hit just about negative 17%. And so, these tenants are still cutting back. The rate of cutbacks, however, for these major tenants is certainly stabilizing or improving. And when it gets back up to zero, that'll indicate that downsizing is over. But this was just, I think, a function of not even AI or anything like that. I think this was just a lot of businesses saying, well, geez, I mean, we've got this office and it, costs $1 million a year, and that's a lot of money. We could do a lot of other things with the money, and so we're going to downsize. So that trend, you can see here in 21. If you go back like to 17, 18, and 19, it was still negative. It didn't just drop from 0 to -10 just in 2021. But again, the downsizing for major tenants. This is probably my favorite chart in the whole presentation from IPCAP. This is essentially a bunch of data on CMBS performance, I guess you could say. So the collateralized mortgage-backed securities market. And I think the main thing to look at here is that bar chart for office, right? A lot of orange, which means that this particular silo in the CMBS market for real estate, the debt capital markets, is in pretty bad shape. So you'll notice almost a third of all office-linked CMBSs need, an equity injection. Almost 20% are in big trouble. And the blue bars, which is, in this case, blue is good, are a lot smaller. Take a look at industrial. It's pretty much 87% are blue, and only 5% are in trouble. 8% need an equity injection, which is interesting because when you compare it to apartments, only 3% are in trouble, yet 16% need an equity injection. So I think the way you think about that is residential is still, because of housing, still viewed as frankly more important than industrial. But the debt capital markets would appear to suggest that industrial linked CMBS investments are a much safer option. So very good to take a look at the markets, the operational performance of the assets, and the underbelly of the financing mechanism. This is a great scatter plot that they included in the update. This is an AI susceptibility risk metric, and I couldn't tell you who figures these things out, but you'll notice in 2027 estimates, they essentially tried to rank vacancy rates and AI susceptibility risk. And so again, if you're looking at these various markets, you kind of want to ask yourself, is there a threat of AI coming in and wiping out demand for office space, and really shooting up vacancy rates? And there's certainly above average risk in markets like, Orlando, San Antonio, Indianapolis, but then they have lower vacancy rates to begin with. It's more places like, the mid US Midwest, which we're, not huge fans of, that could be more susceptible to that. Frankly, anything sort of in those traditional tech areas, I think is accustomed to the concept of AI, and they always have been. So certainly Silicon Valley, but places like Miami, Florida too. And then just in terms of the occupancy, and so this is kind of where, it becomes blatantly obvious that there is quite a big difference between, South Florida's office performance and, other markets. So you could see some of these assets owned by, IP Cap, pretty good size. They're a couple 100,000 square feet, 1.5 million total. And, they are pretty much stabilized, you could say. A couple in the 90s there, the Wells Fargo Plaza well into the to the 90s. But, again, and not kind of cherry picking or anything like that, but it really is night and day when you compare certain Florida office markets to the rest of the world. E-commerce share of total retail sales is by far thought to be one of the biggest and most important things for industrial and distribution and logistics assets. It's sort of the same way the unemployment rate is really the only, if you're only going to think about one thing for real estate, make it the unemployment rate. But if you are going to drill down into industrial, by God, make sure you're following these e-com essentially penetration rates. And they have a long way to go. They're forecasted to go to 30%. The comps for places like Europe are well into the 40s. And if you go to Asia, places like Japan, the e-com penetration rate is approaching 60%. And that's an old economy, right? The average citizen in Japan is much older, but again, they're still using e-commerce at a rate that, frankly, North America has yet to experience. A few more slides here on the U.S. National Industrial Operating Performance metrics. It's abundantly clear. I mean, it highlighted the line in orange to make it even more obvious. But even if they didn't do that, you should be able to look at a table like this and in 2 seconds conclude that, as far as industrial operating performance goes, it's almost a mismatch. It's the U.S. South all the way. But, the West is picking up, and we are starting to see some deals go out that way. A few more slides here real quick from IPCAP. This is really interesting. This is the basically financing, and this is the whole problem with some areas of private credit. There was essentially an oversupply of credit that couldn't make it to enough borrowers because they didn't need it, and that actually put the borrower in a really good position. So you can see these SOFR spreads for some of the IPCAP assets have trended down since about a year ago, and that's a positive, right? If you're an investor, if you're buying these buildings or taking positions in these buildings, that is a huge kind of thing in the a check mark in the plus column for you. So it's great to see that. Great partnership with IPCAP, and we're looking to do more. Okay, charts of the week. A lot of this was covered off by Ken, so I'll try to blast through it. Pretty good pop on the head fake by Trump, and what Andrew is talking about is this, I guess, a target box. So what does he mean by that? He's basically saying that this region around, call it 6,700 to 6,850, captures or has within it both Fibonacci retracement levels from the recent decline. And so, it's sort of, he calls it a logical spot for a rally to go to. But he is becoming more cautious because, again, Andrew's a big fan of sort of supporting evidence. He doesn't look at one indicator and say, yeah, we're for sure going to hit, 6,850. But rather he's saying we may hit that just based on the stats. Unfortunately, there's now, thanks to the technical damage done in prior months, there's a pretty substantial supply of stock up top in the S&P 500. This is going to lead to a situation of resistance, and in order for the market to get through it, it's going to take something sort of material to go past that point. As far as the technicals go, the picture looks more or less the same with the NASDAQ. However, broadness of the overhead band of resistance is a little bit skinnier, and so potentially an opportunity there. But just be sure you don't go ahead and load up on software, because he points out here that despite the gap higher on Wednesday, a lot of software companies did not get invited to that party. In fact, the iShares software tech ETF started out the day pretty good, but actually gave back all of its gains and then finished lower. So you've got some of the companies here like Salesforce and Palantir, all losing ground. So I guess that's the messaging there, is if you're gonna invest in software, you be ready for a reboot. And that's it for me.
Good stuff, Joe. Great slides and lots of information there. So I'll digest that. Let me get started with, I forgot my most important one, my video. So just give me a second to grab it.
Good morning, everyone, and welcome to this morning's brief update from April the 9th, 2026. My name is David Clark. I'm one of the analysts here at NASDAQ Dorsey Ray, taking a look at yesterday's performance, mostly positive for the indices we follow on the video here, though notably negative for crude oil, down over 16% here with the sort of mark-to-market close there, bringing broader commodities lower. We did see most U.S. equity indexes up about 2% or more. International equities leading the way to the upside with EM up over 5%. Taking a look at the chart of crude oil, we see that reversal down into a column of O's, this being the 2-point per box chart, but also a return to a sell signal with a double bottom break there at 96. Also saw a return to a sell signal on the default chart as well. But now we're looking at monitoring support there at 86. But additionally, worth bearing in mind that this morning we're even seeing shares trade back up as the apparent truce is being considered violated by both sides in some fashion. But at this point, seeing crude trade back up towards that $100 level. So we'll keep an eye on that, as well as for the US dollar, seeing the reversal down into those there at 99. We currently see that as the current level of support. Beyond that, we're looking at lows from January down there at 96. As for EEM, reversing back into a column of X's, moving up towards 60, climbing above the 50-day moving average there, putting in support here in the mid 50s with that higher bottom there at 55 on the default chart, seeing the fund score improve back into that mid 5 range there as well. As for EFA, moving back above the middle of the trading band, 50-day moving average as well, and climbing to 102, just one box below its all-time high there from February at 104. As for U.S. equity indexes, we saw the Dow complete a second consecutive buy signal, completing a bullish catapult there, as it moved through its bearish resistance line, moving back into a positive trend, climbing up to 48,000 and matching the middle of the 10-week trading band there. And similar action in terms of seeing a positive trend reversal. In the case of our UT, saw it return to a buy signal with a triple top break there at 25.60 as it rallied up to 26.20 there. Then looking at the S&P 500, saw a return to a buy signal, breaking that double top there at 6,700, completing a bearish signal reversal pattern there as it climbed up to 6,750 right there at the middle of the trading band. As for indicators, did see the BP for the NYSE reverse up notably, climbing from 40% here on the chart up above 50%, up to 52% there. So now suggesting more than half of the roughly 1,800 stocks trading in the NYSE maintain point and figure buy signals. In terms of seeing that level of follow through, we've seen the multiple sell, which measures the inverse of that, but also looking for consecutive sell signals reverse down. So a bit of an additional positive there, seeing an indicator that measures negative action reversing down while others shifting higher. And we also want to give a shout out to the long-term positive trend charts for the S&P small cap 600 reversing up into X's there to 50%. We also saw the PT for the S&P mid cap 400 reverse up as well. Moving on to action from yesterday, Delta reporting earnings positive Q1, though they did highlight fuel costs being sort of their headwind for the upcoming quartering, even further potentially. But at the moment, looking at yesterday's action impact on the chart, saw a triple top break there at 69 for a second buy signal as it rallied up to 74, clearing resistance in the lower 70s there. Now the only level of resistance being that all-time high from February there at 76, support in the mid to lower 60s with the bullish support line there at 62. Looking at Meta this morning, sort of along with CoreWeave taking headlines. Yesterday's action brought Meta back to a buy signal with a double top break there at 600, seeing shares trade back up towards where we saw the chart move toward here in the 620 range. From here, it takes a move up into the 660s in order to move it back into a positive trend. And currently a 1 for 5 after seeing a market RSL signal towards the end of March there, but also seeing a reversal down into O's on its pure RS chart as well. As for CoreWeave, 2 for 5 slightly better picture. Did see it move back into a positive trend with yesterday's action. As it also returned to a buy signal with a double top break there at 89, seeing it similarly trade back up towards where we saw that column of X's there, but pretty volatile name here overall as we see it sort of bounce around quite a bit. So one of those maybe more trading names you might keep an eye on, but at this point do mark some resistance in that lower $100 range as well. But that'll wrap us up for this morning.
Okay, some interesting points there. Okay, so let me go and show Michael Kulba. Okay, so he's back giving us stuff. So reminder, this is one of the most hedged environments over the past 15 years. Funds likely feeling a lot of pain on the short side these past few days, for sure. Here we go, emerging markets. So U.S. versus the emerging markets. The war brought about a healthy rebound as investors sought out the relative safety of U.S. assets. But if we had hit a turning point in the war, do the most vulnerable stage a comeback? Yeah, I should think they will. We'll see. A dollar unwind, and that's really what a lot of this war is about, in my opinion. From one of the most aggressive short bets to near record bullishness, the dollar has only been able to rally 4%. Not a great sign for a bullish outlook on the greenback. I'll show that later when we come to the point and figure on the various currencies. That's what a lot of this is about, is the fear of the US dollar not being the global currency that it always has been. Trump presidency seasonal pattern. There's just something about the first 4 months of Trump presidential years. If this is a capitulation point of the year, I'd expect all attention to turn to midterms after dealing a setback due to self-induced inflation concerns. The political stuff. More good news on the Venezuela regime change. We welcome the pullback in oil and oil-related equities on the U.S.-Iran ceasefire. Global infrastructure has been damaged and needs rebuilding, and the rebuilding of Venezuela's capacity only bolsters the bull case for oil services. Yes, be adding to those. Chile's still within a strong uptrend. After becoming heavily overbought in late January, the recent correction appears to be stabilizing, right where we'd expect a bullish environment. Freeport McMoran, who want to be buyers of uptrends, look around what assets corrected within an uptrend breakout versus those that established bearish trends. Copper, ArcelorMittal. Again, with sectors, industries, which sectors/industries are resuming their strong bullish trends? Metals and minings have been one of our primary plays via our global protectionism theme. Do you think countries will increasingly hoard commodities, strategic assets after the Hormuz situation, or share the love? Yeah, I think it's the former. Australia, just showing that the Australian market is retesting there. So, okay, so that was that for Michael Kulba. He also reported his March numbers for his fund that we're part of. Picked up another 2.85%, running at over 10% year to date. Yeah, he's doing exactly what his job is, and that's just to be really nipping around the edges. Still a very tiny fund. We're hoping that he'll find a way to be able to add some more, and we'll continue to try to help him with that. So good for him. Asset class performance before I go to the other side. So Canada is still in the green, up 5 to 6%. Venture exchange has dipped down. S&P, NASDAQ, and the Dow are all in the red. China's everything, most of the other ones are green except for Germany, and India still continues to suffer. So I guess India is like the opposite of AI. Very outdated, and no one wants to put money there except us. So crude oil, yeah, it's had this incredible setback, which was expected with this hopefully good news. 2 weeks will tell, or maybe it'll be 2 minutes. You just can't tell in this world anymore. Nat gas suffering a bit. Gold sort of holding its own. Silver down a bit. Copper showing some signs of life. I'll do the currencies and interest rates on over here in the playbook. Canada US dollar, nothing's changed, still at 72 cents. And both the short-term and the long-term indicators are measured down to 69 and 62 respectively. So we'll have to see. Now I was going to comment on the US dollar spot index. And once again, I always like to point this out. This is the most important currency in the world. It's made up of the euro, 57%, 13, pound sterling, 12, and Canadian dollar, 9. So it does have a huge effect on our Canadian dollar. When it's up, our Canadian dollar tends to be down. And ever since Trump's first year or second call to office, he pushed it down a record amount last year, 12%, I believe that is. That's even more than his first term. And now you can see the trend is up. It did get pushed down a little bit with this war. And but the overall trend continues to be down, except in the short run. So that's a very powerful currency. It states the whole world against it. Okay, moving on to, I'll just round out commodities here. So crude's down to 94, measures down to 72, so still quite a bit of downside. Still up 64% this year. Nat gas at 272 measures down to 255. It's down 26%. So that's more free flowing, if you will. Yeah, the producers stay away. Copper slightly up, uranium a big up, gold up both on the futures and the spot price. So that's probably going to start to kick in again, as will the gold bugs a little bit, and the majors on the Van Eck up a bit too. Juniors look up, silver still up. So yeah, the precious metal, gold and silver complex continues to be up. Been giving presentations lately, and last year gold was up 64%, silver was up 140%, and platinum was up 120%. So three major market movers there on the precious metal side. Junior silvers look to be up. Platinum looks to be up from 2,000 to 2,360, so on. Moving on to digital cryptocurrencies, and Bitcoin still looks like a dog, whereas the rest of the complex looks to have some legs. So see how that sorts itself out. Money center banks look to be up, and the regionals, this is a big change here. They've been pointing down for the last little while, and so that direction is going in the right way. Canadian banks look very strong. Yeah, their wealth management divisions still continue to scalp. And finishing up on interest rates, see what's happened here, because I wasn't here last week. So no change in the 2-year at 379, measures down at 275. The 5-year, this is a larger change at almost 4%, measures up to 5.25. The 10-year at 430 measures up to almost 5%. And the 30-year at 490 measures up to 5.6%. So still a lot of inflation left in the cycle. We've been trying to get John Williams to do a session with us, but we're not hearing back from him. So hope his health is recovering. And that's it for me. Sean, are you ready?
Yeah.
Take it away.
Okay, so the macro overview for April 9th. Not much going on in the portfolio despite a lot of ups and downs. Kind of tracking Bitcoin and Ether year to date. I'm short biased in the equity markets overall. It was a little bit painful yesterday, but kind of expected a taco, and the rally in Bitcoin helped quite a bit. Yeah, the big theme right now is war. How long is it going to continue? If it continues, oil is going to remain expensive, and industrial supply chain is now being quite impacted. Jet fuel, ethylene, other industrial distillates that come out of the oil industry. So the bottom line is they have a ceasefire, but Israel was not a participant in the talks. And this war is frankly all about Israel. So Israel is not, in my opinion, going to moderate until there is a regime change. The U.S. wants out of this war, as we've seen. So we've got some conflict going on here. I think we're looking at a quagmire, unfortunately, and I think we're going to have high oil prices that will lead to a global slowdown. We're going to look into that. Deleveraging is going on due to the volatility. You're seeing massive funds selling things that they're up on, and they're up on a lot, right? Like the last year has just been, really fantastic. We're in a challenging moment. We may have an equity top in the rearview mirror, but we'll talk about that in a second. Looking at the asset classes for the past week, because of the big move down in oil yesterday of about 17%, we've seen oil fall dramatically. We've seen Bitcoin up. I'm surprised that gold is down with the dollar down, but that goes to people taking profits in gold, is my understanding. Economics, very little has changed. I think we're heading into stagflation. What has changed materially, like I remember a slide being up on this very page where it was 5.4% expected growth from the Atlanta Fed. Now, looking back, we attributed that to gold sales, which seemed to be continuing to move out of the US. The current growth outlook of 1.3% is not great. That's going to put a lot of pressure on the Fed to cut rates at a time where they're going to be facing inflation. The US dollar strength has waned on the back of the ceasefire. They want it lower. I mean, they want this dollar much, much lower. We had a flight to quality due to the war. I don't see us changing very much in the US dollar. Gold, you look at the longer term trends, they're still sloping up to the right, bullish. And since the war started, we've seen a premium and a flight to quality. And the trend, which was broken, partly due to margin changes and then some shifting around and people taking profits as they move to cash or treasuries. So you're seeing the heat map starting to clear, starting to see some blue and yellow show up. I would expect to see the gold bull run continue. Silver, same thing. This is going to tell China we definitely want to reduce our dependence on oil. Let's ramp up solar. They have a massive deficit in silver required for industrial production. And while growth globally may slow, I don't see solar really slowing much. I'm expecting it to accelerate, but right now we're just going sideways. Oil is all about the war. Like the Strait of Hormuz, open, closed, obviously it needs to be opened. I don't think it's mined at the moment, because if there was ever a mistake and you lost a ship because of a mine, it would just shut down and then people wouldn't be able to trust the Iranians to grant safe passage. Now, the one weird thing that is happening is the Iranians are forcing traffic up and around one of their islands that's in the strait so that they can really get a look at it, but also to impound a ship if they don't like what they see. I think this is a big problem. Again, the US is not in alignment with Israel on this war at this point. Israel wants the complete destruction of the Islamic theocracy. And Trump just doesn't seem to really care about it that much. But he went along with Israel. He's got elections coming up. This is literally the definition of like a Mexican standoff quagmire type situation. Oil futures, however, are just saying like, this is all going to get sorted out by the end of the year. Guys, will be like sub $80 oil. I'm expecting the shape of this curve to change pretty dramatically and flatten out, with the short end staying up in the 85, 90 range, and much less of a downslope. Rates and credit, really no change. Equity, we've gone from extreme fear to fear. Trend indicators are still weak. There's a bit more rotation into the broader market on this very short-term rally. The VIX term structure was deeply inverted, but is now basically normal. And we'll show that in a second. Are we back on trend? The S&P 500 heat map is picking up. We're seeing we now have 5 positive indicators. Again, the blue is the shortest term, yellow is midterm, and green are longer term, like 60 plus days. So this can still fit within the downturn of that the red moving average. Right now, AI spend is being questioned. At the same time, this new Anthropic cloud model called Mythos is another step change in performance, to the point where it's discovered so many security vulnerabilities in existing infrastructure reliant software that Anthropic has only released it to firms that need to correct. So they've given it to like JP Morgan. It'd be like you get this piece of software and you run the Interact software all through it, and you find like 15 very serious security holes that teams of experts over a decade hadn't found and corrected. And this software finds it in a day and can, in the wrong hands, be used to really take down networks, take down critical software. This is a big deal. It's behind the scenes, but let me tell you, there's a lot of concern with software developers about infrastructure software right now. So this pop that we've had, I'm calling it the war dip blip. We've had a big gap up. Traditionally, gaps get filled. So to me, that's saying like there's potential downside here. And when you think about what we've gone through, the potential escalation that is, I guess, theoretically still on the table, we're only down like around 3% from the recent highs. That's incredible. The VIX right now is going to be like sub 20 by the end of the day if this keeps up. The drop in the equity market was less than a correction. It was like down on this chart, 8%, 8.4%. That's a pretty resilient S&P 500 given what we're facing. So if oil is going to go back to 70 by November, December, maybe this is all true. But my read of the situation is we're not going to be there because Israel is not satisfied with the progress that they feel that they have to answer to. The U.S. wants out. Here we can see the VIX curve was inverted very much last week, now back to normal. This is like saying, go ahead and invest. Ideally, we'd like to see the spot VIX, the dash green line, like around 12 to 18, and then some form of an upwardly sloping forward curve in the VIX term structure. That would be ideal. But given what we've gone through, man, this is pretty darn good. Crypto's just broken right now. It's a broken risk asset. The downside could be 45K. The probability of that in my mind is falling. And I'll tell you why. The sentiment is terrible. We've got to see this U.S. Clarity Act get done. We've got to see Coinbase get full access to the U.S. banking infrastructure. And then I think we can see a move higher. And because the big question right now is still who needs Bitcoin? Very few people in the Western world need Bitcoin. I'll tell you who needs Bitcoin. The U.S. Treasury. The U.S. Treasury needs crypto. They specifically want stable coins to be able to become the biggest buyer of U.S. Treasuries on the planet, right? They've put forward the Genius Act that said if you're going to do a stable coin, it has to be backed 1-to-1 with U.S. Treasuries at a time when China, the Middle East, Russia, and even Japan are not going to be there to buy treasuries in the same capacity or with the same long-term view, especially if they plan to weaken the U.S. dollar. The U.S. Treasury, to avoid failed auctions, they need this Clarity Act to get approved. And Besant put out an opinion piece in the Wall Street Journal today saying, come on, we need this, we need it now. A big picture, you've seen this before. I think it's midterms versus oil prices. I'm watching the yen. The yen is at a level where it's required interventions before. The yields in Japan are rising to the point where people will be indifferent between holding U.S. Treasuries or holding domestic JGBs. We've all been focused on the war, but markets have, while they faced a year of chaos, they've still done awfully well. And I was thinking that this morning. This is a 1-year performance chart of futures and indices. There's a lot more green on there than red, right? And in size too, like gold, silver, S&P, NASDAQ. Overall, this looks like it's been a very good 12 months, even though we're, looking in the rearview mirror on this. The road ahead is we're going from pavement to gravel. And is it a top? Let's find out with employment. Employment is really going to start turning that. The focus is going to be there. Inflation is going to have a big influence. And if it's a stagflationary environment, as I expect, this will be a red chart a year from now. So invest accordingly. As Dave pulled up, if you look at the 3, 5, 10-year numbers of the CAGRs, we've had a great ride. Okay. And people have just internalized that. There's this buy the dip mentality. At some point, we're going to have to listen to Gilbert a lot more on moving a higher allocation towards the short side. And the cartoon for the week hit me this morning. Hegseth, the tracksuit you ordered has arrived, and we've cleared the track as you requested, sir. Like, he was on TV yesterday just taking a victory lap like I couldn't believe. And those generals just must be like, have you heard that one about the fat lady singing there, Pete? Anyway, that's it from me.
Good one, Sean. Yeah, that guy's unlistenable. I literally just turn it off. But I tried to do that with most politicians. Okay, thanks for that. So Chris Curry and Paul Beatty are not here today. So Gilbert, I guess wrap things up.
Okay, great. Let me just get my slide deck ready here. This is going to be a quick one today. Okay, hope everyone can see my screen. Yeah, so this is a short report for April 9th, 2025. Just give me a second. There we go. Yeah, so S&P 500, again, the long-term chart, we can see here we didn't, obviously, we didn't come down to this long-term support, which, while, we do have a nice rebound here, this tells me that this really doesn't look like a long-term material bottom. We're going to take a look at some breadth measures a little bit later, which can speak to that. Taking a closer look, again, when we look at the comparison to 2025, again, we had this sort of flirting with the 200-day exponential moving average. We've now popped back above it, but as Joe pointed out here, we've got a lot of resistance here up at this previous 7,000 level for the S&P 500. Same for the other indices as well. Longer term, when we take a look all the way back to the 80s, we can see that we've been well above this longer term 200-month exponential moving average. I think that if the market starts to move a little bit sideways, even after this bounce here, there's going to be a lot of talk about how the current structure looks a lot like what happened in 99 and 2000, because we did have the tariff tantrum, which is analogous to the long-term capital management fiasco before there was that rollover. CAPE ratios continue to be very elevated, even though pulling back here longer term, still flirting with the highs that we saw in 2000. When we take a closer look here, we can see that we have sort of pulled back from that dip a little bit. However, this looks very much like what we saw towards the high in late 2021, early 2022, which saw the market then roll over. Credit spreads, again, yes, we did have a pullback with this market rebound, so credit spreads have tightened a little bit. However, we have to point out that this is just putting us back in that same red zone where markets historically have not moved a lot higher from. And when we take a look longer term, we can see that this wedge that's been building since 2008 continues to get tighter and tighter and tighter. Defense versus growth, we see that obviously with markets moving higher, we've had a rotation back into growth from defense. However, this is just putting us again back in that same unattractive level where growth has been not as attractive relative to defense. And so we could get that market breadth. We're taking a look at the S&P 500 stocks trading above the 50-day moving average. This was actually from last week, where I pointed out in the near term that typically when we get down to this 20% level, that's where the short side, the near-term short side is no longer as attractive. And we did have this nice bounce here, so we're moving a little bit higher. Longer term, however, in terms of a long-term low here, this is stocks trading above the 200-day exponential moving average. We didn't get to that deep level that we were looking for, which is typically where the market signals a longer-term bottom there, so around 25% to 30%. Looking all the way back to last 15 years, you can see that major market bottoms coincided with breadth getting down to this 25% level, which that wasn't the case with this pullback right now. In terms of a long-term solid bottom, I don't think that breadth is suggesting that's where we are right now. So that's it for me this week. Again, if any of this does concern you and you're looking for a solution to some of the downside risks, we have a solution with our partners at Universa. Reach out to us and we'll see if your profile fits us. So that's it for me this week.
Great. Thanks. I guess we can wrap up the recording.
Thanks for listening to Lighthouse Outlook. If this conversation sparked a new perspective, share it with someone who thinks differently. Subscribe for fresh episodes every 2 weeks and visit mcnichollasset.com to learn more.